Good morning, good afternoon, everyone. Hello, my name is Rick Calvoda, and welcome to our third quarter market performance call, or what we like to say internally, the Phil and Robbie show. This is now our third quarterly call where we discuss not only property level performance for the prior quarter, but also provide insights into the underlying valuation data that we collect and its impact on those returns. So as a reminder, the performance information you're about to see is for the NCREIF ODCE index, and it covers all 27 of the ODCE funds, whereas the valuation data we present, that's reflective of the 25 ODCE funds that we work with, so 25 out of the 27. But it's also based on the insights on more than 10,000 valuations that we oversee each quarter on assets totaling in excess of $900 billion in gross asset value. By analyzing these changes in pricing and cash flow assumptions, we're not able to help you understand the changes from the prior quarter and the performance, but also gain real-time insights into the current quarter valuation process. And given how fast things are changing right now, that real-time insight is critical at this point. So Phil and Robbie have a lot to discuss this time, but we will allow about 10 minutes at the end for any questions that you may have. So be sure to use the chat feature if you have any specific questions, and we'll try and address them in that 10 minutes at the end. Also, as a reminder, as I mentioned, this is a quarterly call, so you can mark your calendars for next quarter's presentation. So it'd be the fourth quarter market performance call, and that'll be on February 3rd of 2022. So again, thanks for joining, and I'll now pass it to Phil and Robbie.
Thanks very much, Rick. Hello, everyone. Thanks for joining us on our webinar today. So as per prior quarters, we'll go through the information. There's opportunities to drop questions into the chat, but Robbie and I will hopefully narrate everything through. But yeah, thanks everyone for jumping on the call. So let's get into the detail. So the other point just to stress up front is, yes, this is all the ODCE portfolio, it's all 27, but we're looking here obviously at just the pure real estate part of it. So there's no leverage, no cash, looking at how the actual real estate performance levels are playing out, which clearly, as you can see here, have been stepping up kind of quarter on quarter, and we thought kind of Q2 was a strong result. Well, Q3 has simply eclipsed that. With a return kind of rising to an unprecedented 5.7%, starting to make the kind of downside of the pandemic from a return standpoint feel like an increasing distant memory. But there are lots of variances within that overall number that we want to unravel over the course of the next 45 to 50 minutes with yourselves. So first point to note is now we're seeing positive returns firmly entrenched across the board, across each of the major sectors. With the appreciation levels on the rise on all sectors. We'll come into the appreciation piece in a bit more detail. But there's still kind of very much kind of two sides to the market, and it's a kind of time of huge disparity, almost a 10 percentage point spread when you look at the spread of returns across the top to the bottom end of those sectors on a quarter, and that rolls up to almost a 30 percentage point spread for the year. But at the top end, really in a league of their own. Industrials are kind of just pushing further ahead of the rest. I don't think there's been a point in recent history when we've seen a return from a single sector hit double digits in a space of 3 months. That's kind of usually the type of return that gets accumulated over the space of a year. So 11.6% return for industrials is a real standout in that regard. An annual return alongside that of north of 31% is the kind of performance level that typically gets played out within the strongest listed sector. So we're kind of running out of superlatives for this sector, but we'll try to get some. The alternative real estate sector at the bottom, most of which is self-storage, they're also in significant growth territory, a return of 7% for the quarter and north of 20% for the year. And then you have apartments really stepping up to the plate. A return of 6.6% there was near double the prior quarter, and they've reached their own milestone in Q3 because you can see they've just moved ahead, and you can see from the insert they've just moved ahead at the overall ODCE return, and in doing so, really further distancing themselves from, I guess, what at the end of the day would from the traditional real estate sectors of the offices and the retails, which are very much languishing at the bottom and the end of the order. And down there, you really have kind of only 10%, 10 basis points now separating offices from retails. But everything is on a gradual upward trajectory there as well still. Even better way to see how the fortunes have played out across the sector is to look at how appreciation levels have played out here over the 2 years since the onset of the pandemic. So grey bars kind of 2020, kind of blue bars the year to Q3 of this year. And a very different set of circumstances being played out here. First of all, overall, it's worth noting that the values are now net up since the onset of the pandemic, so they're net up by 6.7%. Now, industrials and other, for whom the pandemic was not really a factor in 2020, have been the mainstay of those value gains, really moving ahead in the last 12 months as well. It's apartments on the grey bars, offices, and the retails where values were written down during 2020. Apartments have now come out the other side, and they're now net up 7.7%. Offices still kind of caught in this period of uncertainty and kind of values pretty much flatlining over the last 12 months. Retails now while the value decline is easing, so it does look as if retails are clearly through the worst of it. And it's also worth noting that actually these are 1 year. If you took the 1 quarter, then values are up in each of these sectors over the last 3 months. So what's this very different set of circumstances meant for portfolio structures? And we actually had this question thrown at us internally, so we thought we'd bring this out in a simple kind of stacked bar chart to show how those kind of sector weightings across the Odyssey funds have altered going back to the start of the Odyssey property level time period back in 2013. So go back then, industrials were about just south of 14%. They're now kind of almost a quarter of these institutional portfolios up over 10 percentage points over that time period. Offices have gone from the high 30s to the low 30s. Retails have also clearly been scaled back, now just over 12%. Apartments have pretty much held their share around about 6%, and obviously then at the top in that yellow you have the new kids on the block in terms of that alternative real estate sector. So yeah, maybe to you, Robbie, because I threw this at you the other day, I think you looked into this a bit more detail. The one thing that kind of stood out for me is the scaling back of the office weights more so than the retails, especially when you look at the kind of relative movements in appreciation of offices versus retails. You would have thought that maybe the retails would have taken more of a knockback. So maybe your just thoughts on that one, Robbie.
Thanks, Phil. Yeah, I mean, do I look at the shift to industrial? It started like 17, 18, right? So it just during the pandemic, it's accelerated that increase to the industrial side, right? So if you look at it, it came from the retail and it came from the office sector, right? So that decline in office kind of gets 17, 18, that's already starting it. I think that the past couple quarter, you look at retail's been stagnant about that kind of 12.4% kind of allocation, right? So versus the office continued to decline. I think partially as well is that basically people can still sell an office today, right? So we'll talk a little bit about it later on as well. There's more and more transaction in office, right? So versus retail is the only portion that there's some transactions, the grocery side. There's some green shoots up showing up, but the mall is basically there's not a lot of demand there yet, right? So that's why the stagnant point on the retail front versus people are selling the office side, and continue to increase the allocation to industrial, and as well as apartment, as you mentioned, it's basically maintaining its share, right? So, but it's going to continue to holding up pretty steadily, and while the other sectors actually declining, right? So the retail and the office sector. So.
Yeah. And I think we'll do a bit more work on this chart and actually break out the next quarter the investment piece from the value movement. Yeah, but there's clearly something, obviously, in terms of less trading out of the retail sector, more kind of movement, disposals maybe in the office. As you say, we've got some of that later on in the presentation as well, from specifics to actually influence some of those returns. So back to the top level, this chart puts kind of into context the kind of uncharted territory, I guess, the market finds itself in at the moment. we're breaking the return series down there into capital and income and appreciation. This slide also separates out the stabilized from the overall return. So just the 5.7 for the quarter. If you look at that on a purely operating asset basis, that's 20 basis points low. So development properties are providing some form of premium that gives folks the kind of interpretation of how much upside those developments are bringing to the overall return level. But whether it's kind of all property or just operating assets, I mean, it's a period of, I think, mathematically, it's called exponential growth at the moment, with those appreciation returns, those red bars doubling up quarter over quarter, and hitting kind of record levels over the last couple of quarters. I think this Q3 return is in excess of anything that was reported back on the market, even if you go through back to the GFC, when clearly the market kind of rebounded, but witnessed more of a kind of longer drawn out recovery. I guess the question is, how long can this growth period be sustained? I mean, in previous years, kind of what's taken almost a year to play out, we're seeing now play out over the space of 1 or 2 quarters. So I guess, Robert, to you, is this a sign that things to come, that, I mean, our cycles becoming shorter, they're becoming, as you see here, kind of more volatile, or is this I guess a one-off kind of occurrence of a perfect storm, COVID recovery, wider investment arena? What's your kind of take on why we're just seeing such exaggerated movements at the moment?
Yeah, I think do I look at that, there's 2 factors to it, right? I think the major factors on the demand side, right? So the shift of behavior, right, during the pandemic, and then the shutdown, and then reopening, right? So during the reopening, that's why you see this kind of spike going on the past 2 quarters, right? So on the demand front, and then you couple with the capital market side, right? So the low yield environment is expected to continue, right? So financing is still available, investor demand to real estate sector kind of continue to increase as well. I think that's two tailwind that push the appreciation to this record high in the past quarter.
Sure, and we can actually unpack that now in the next slide. The other thing, maybe just to quickly point on this slide, is the income return piece at 1.1%. That hasn't actually nudged down. I mean, with this ever increasing kind of capital base, you would have thought maybe a bit of a lowering of the income return. That maybe also plays to the fundamentals. So let's get into the fundamentals that are impacting on those values. So as Robbie alluded to, what we're able to do at Odces is to unpack that appreciation out of the return. We transpose the red bar here into the red line, and bifurcating appreciation into what's termed the yield versus the cash flow drivers. The yield effect, which is in the yellow here, is the impact of what might be termed kind of pure pricing levels on value, the impact of change in discount rates, exit caps. That's the kind of investor sentiment part of the equation. For cash flows, we're identifying the impact on value from the change in the forward projected cash flow levels, and that's more of the market fundamentals. CapEx, the grey bar is the third layer to consider here, is you don't bank all that change in value from a return standpoint. So the appreciation return there of 4.5% for the last quarter is the change in value net of the amount of money that's been spent, which kind of takes about 30 basis points off it from an overall return standpoint. So if you refer back to 2020, and if you think of the kind of two-way split of this kind of yield versus cash flow, and we've said it before, it's a reduction in cash flow levels that really took value south during the onset of the pandemic. The recovery was then initially more kind of investor driven, and that really hasn't let up, to your point, Robbie. And you can see the size of those yellow bars kind of in each of the last 4 quarters. But it's the market fundamentals, those blue bars, that have really now become the leading component of growth. And if you kind of look at the ratio between the yield versus the cash flow, it's about a 60-40 split. So what we're now seeing kind of in those cash flow pieces is that the contractions back in 2020, part of that is being reversed back out again, and with rents and growth rates in certain parts of the market pushing ahead, and also hitting certain sectors record levels. And it's that, I guess it's that duality, it's that perfect storm, investor sentiment, improved market fundamentals, that have really pushed appreciation to these new heights. But these are all property averages, so we need to investigate how those kind of those trends are working out across the individual sectors. So on the next slide, you want to be looking on the right-hand side of each of these sector charts. And Well, first of all, it shows that on the red line, the growth is really just contained to the apartment and the office. And I've also done a little bit of animation so you can flick in and see the other sector as well. But let's start with the apartments. This is where the positive pricing effects, those yellow bars, extended back into kind of the real period of the pandemic back in 2020, when it was kind of investor sentiment that was in part protecting values during the early stages of the pandemic when cash flows were being lowered. And there's been kind of clearly no let up in that investor demand. You see those yellow bars getting slightly larger as you move to the right-hand side of that chart. But added to which cash flows levels are now recovering. So you really do have this kind of this dual positive now at play, pushing up values, 50% yield, 50% cash flow. So, and actually when I look at this, Robbie, I mean, this is the one sector that really does feel like it's an uncharted territory. I mean, running up to pre the pandemic, it was pretty much flatlining back to 2016. So it's really doing something different to what it's done in its more recent history. So is this set to recover? Is set to continue? Your thoughts, maybe just on the top level around the apartments at this stage?
Yeah, and then do a look at on apartment front. Maybe people talk about lack of housing for a while now, right? So during the pandemic, there's not a lot of development. People stopping development, right? So with the uncertainty last year, and then we kind of look at apartment, it tied to a lot of job growth, migration, and job growth coming back, and people are more comfortable, right? So during last year, a lot of people move in with the family, right? So this year with the job, with certainty, people are now moving back out to apartment, right? So you get the demand front of it, and then the other thing, lack of housing, right? So people chasing after the same kind of apartment, the limited apartment unit, especially with the migration in the Sunbelt market, right? So you got all that equation going in there with the construction cost high, which limit the new supply, right? So all of that play into the apartment side and capital market side as well. You got low financing, right? So low interest rate financing, and you got high investor demand, right? So that's why you get the two things going on in the apartment front. So that's how I look at it, that apartment, basically it is an uncharted territory. It is kind of going up. There's a lot of people going in there, and fundamental are very strong. And even gateway market, like people are back to back reopening. People are now back to kind of the gateway market as well. So you see a lot of positive sign on the apartment side.
Yeah, and we'll look at that kind of gateway versus Sunbelt in a while. On the industrial side, the dual positive that we're now seeing on the apartments has been obviously playing out with industrials for a number of sectors and just going from strength to strength. I think it's worth making just the observation that actually the upside and appreciation for industrials is about 2/3 cash flow, 1/3 pricing. So it is really kind of more the fundamentals that are driving those values to record levels. So kind of maybe you're just kind of the observations around the kind of supply demand kind of criteria that's really elevating that industrial number, Robbie, at this stage.
Yeah, on the industrial front, I feel like I'm the weatherman in Southern California, right? It's always sunny. The only different thing is the temperature, right? So, and then in the industrial front is basically the past 2-3 quarters, we have been talking about the tailwind industrial side, right? So the demand front, what they call the supply chain issue, which create more need for warehouse, right? So, and then with the shortage, labor shortage, land availability shortage, will limit the new supply, right? So, and people still continue on buying more stuff, right? So this is a retail sales relatively increase, which again, now a lot of people buying more online, need more warehouse spaces. So that's how I look at it, is based kind of demand side, the limited supply side, and then adding on top of it, the capital market side as well. So similar story to apartment, but the industrial have been going on for a while, and it's continued to accelerate it, right? So we can talk a little bit in different market, but yeah, it's definitely an interesting kind of an interesting asset where the supply are really, really limited.
Yeah, well, I suppose just flicking that industrial for other, then yeah, it's almost a bit of both, isn't it, in terms of the limited supply side around maybe some of the storage side of things, and so that's really elevating the rental positions. Then almost that kind of works hand in glove with the dynamics on the apartments with the migration around that. And there was obviously this initial peak there, or spike in terms of investor sentiment. Most of this is storage at play there. On the retails, things, obviously it's gone through this kind of torrid period of correction from both yellow and blue yield from a cash flow standpoint. things are easing off and actually kind of starting moving into positive territory. Less on the pricing, more on the kind of just the fundamentals and some of those rental recoveries. So maybe just you read top level on those retails in terms of maybe why there hasn't been that much movement on pricing and that cash flow piece. I assume you expect that to continue, Robbie.
Yeah, I think that on retail, the fundamental have improved, right? So we talk about retail sales have improved, rent have improved. So you start seeing that in that blue bar, right? So, but investor demand are not fully back yet, right? There's some transaction. We'll talk a little bit more later on, right? So there's some transaction happening on the grocery side. There's a little bit dipping in as well on the green shoot on the lifestyle center, like the Class A one. So they're definitely a little bit more here and there, but not as much in the other sector yet. So. But fundamental definitely have improved.
And then you have the offices, and there's so much going on in the office market. So, but you know, on the wider scheme of things, it really hasn't moved a great deal. It's almost feels like a sector shrouded with uncertainty. No real movement on pricing. Most of the variant there is on the cash flow side of things. Cash flows are thankfully started to edge back up again. But these are overall levels that we're looking at here, and it masks a whole lot of variation, both at a kind of regional level, but also a more localized urban versus suburban. Maybe I'll reserve your comments on that, Robbie, till we get into that level of detail. But whatever the sector, things there, it's improving trends that are very much the order of the day. And this just looks at the last quarter, but varying degrees. So here we're kind of ranking the individual sectors in terms of appreciation, those green bars on the left-hand side, decoupling them into those yield and cash flow effects. This is just for Q3. Everything is sitting to the right-hand side of the line, so a bit of a watershed moment in that regard, albeit the improvements are pretty minimal down the bottom end there for the offices and the retails. And within that rank order of appreciation, the effects of those orange bars, the yield and cash flow both playing their part in determining the hierarchy. Still more tilt towards cash flow, but you know, maybe just a quick kind of comment on the yields, Robbie, where sectors are currently priced and how that's altered through the pandemic. So got a series of numbers here just to kind of flag up what's changed. And this is grey bar, this is Q3 2019, blue bar where things are priced Q3 of 2021 this year. So I'll throw some numbers, Robbie, you can put the context around that. So the overall change is about 20 basis points. The industrials, compression, there's the industrials there, kind of 50, 60 basis points, whether it's discount rates at the top, exit caps at the bottom, averaging exit rates at around about 4.8%. Other, about a 40 basis point movement, softening. Apartments also about 40 basis points. So when you're thinking about the impact on appreciation, that industrial movement has added about a third to values, as has the other apartments. About half the change in values coming from that. Yeah, yield movement. No, bit of movement up on the retail, not much change on the offices. So, Robbie, maybe your thoughts on the movements and the levels and how that kind of sits maybe in the wider context out there.
Sure. I mean, do I look at it on the overall movement, right? You indicate like 20 basis point. Like, so in comparison, basically Treasury have moved down like during this time period from 1.68 to 1.52. So it's down by 16 basis point on 10-year, right? So that's kind of a little bit correlation, the spread versus the 10-year Treasury, right? So on the overall movement. And BAA yield, kind of which is what typically correlated to the pricing on real estate, is down from 3.91 to 3.23, right? So that decrease is 68 basis point, right? So if you look at it, the spread actually to BAA yield, it actually have increased, right? So, and which makes sense as well. Apartment industrial, being industrial, have much more movement. That's where a lot of positive sign on industrial, both on demand, right? So, an apartment have been holding steady with Freddie and Fannie financing, and then now with investor demand and actual demand, physical demand as well, right? So that's kind of the two that's going to show movement. An office, yes, there's not a lot of movement, but with the 10-year Treasury moving down, the BA moving down, the spread actually increased, right? So that risk profile have increased in relatively to kind of the spread side. And retail, which makes sense, right? The retail is uncertainty in the mall side. There's more certainty in grocery side, but the mall side still uncertain, right? So that's kind of showing the increase in spread there. So And other self-storage. Self-storage is very similar to look at apartment, right? So they tend to move similarly as well. So that's why you see the same decline there.
Yeah. I mean, for me though, when you look at the 1 quarter here, I mean, the real plus point is the strengthening of those cash flows. I mean, especially bearing in mind that cash flow component was negative in the opening 3 months of the year for apartments, offices, and retail. So opening up that cash flow piece. Folks hopefully on the call are starting to get familiar with this. We relay the cash flow effect across to a series of kind of valuation metrics. So this is showing the percentage point change on those metrics over just the 3 months, and we're 5 of the metrics shown here. There's a multiple that you could bring out. There's no perfect science to this, but it's the color coding gives you a sense of what's having the upside and the downside impact on those cash flow influences on values and the order of magnitude of those as well. And that encouraging point, first off, pretty much greens across the board. Yes, down here, retails and offices, still seeing some of those occupancy levels head south. And I guess that would maybe more interesting to kind of keep a watch on maybe for the offices. So it's kind of interesting narrative there about kind of firms kind of continuing to consider downsizing their space requirements. On the retail side, kind of upfront, that's the upfront market rents are down a shade, but that's then partly balanced out by any improvements in growth rates. Those are kind of 10-year projected growth rates. But the stronger cash flow piece at the top end here for industrials and other, that's really kind of that's where the action is, and that's built foremost on improvements in those upfront market rents, and industrials also seeing an improvement in the forward projected growth rates as well. They've been stepping up. That's, as I say, a 10-year average change of 10 basis points over the quarter. So if you open that up for year 1, year 2, and year 3 of that, then you can see that for year 2 and year 3, the industrials have strengthened more so than the other sectors. Apartments have actually seen more improvement in their year 1 levels, but I guess a lot of this is normalizing back to where things were at pre-COVID levels. Whereas those kind of increases on year 1 for industrials are most probably pushing ahead of where they were 2 years ago pre-pandemic. Whereas if you look at the improvements that we're seeing on the offices and the retails in the 1-year growth rates, that's still lower than they were pre-pandemic. So some way to go before you kind of reverse out the losses that were modelled, I guess, during the earlier stage of the pandemic. The next slide kind of maybe does that narrative a bit more justice. This is 1 quarter. So if you look at the change over the 2 years, so from pre-pandemic to where we are now, maybe just continue to focus on that 1-year growth rate. So apartments are pretty much back at parity where they were, just north of 3%. This is the movement over the 2-year period. So 1-year growth rates are now back where they were. Industrials are ahead of where they were 2 years ago, so they're up about 4.3 to put a number into that. But offices and retails are still kind of sub where they were on their 1-year rate. So even though they've come back a little bit in the last quarter, if you look at it over the 2 years, they're still kind of 1.7 for in offices, 2 percentage points down on those 1-year growth rates. The other metric we talked about a lot in this graphic is this kind of year 1 operating expense ratio, and this is the metric. This metric covers the ratio of year 1 out projected operating expense as a ratio of the year 1 projected out anticipated gross rent. So with the exception of industrials, these are risen across the board when you're looking at things over the 2 years. Now, obviously within that, we're seeing, and you can see over the last quarter, some of that is coming back a little bit. So some of those kind of rent concessions are being reversed back out, but some of this increase in this operating expense ratio, I guess, Robbie, is going to be the increased cost part. So some people may assume that those rents will reverse themselves back out, but do you think maybe the cost element of that metric might be here to stay a little bit as well, and hitting certain sectors more so than others?
Yeah, so this is the headwind, right? So we've been talking about the tailwind kind of for all the real estate sector. this is the headwind with this inflation headline news kind of for a while now, right? So and we talk about it the previous quarter as well, the increased expenses, right? So insurance costs, labor costs, property tax. So it's definitely here to stay, right? In relatively to kind of previously. And I think that's kind of we have to kind of continue to monitor. That's kind of what so far right now, the increases in revenue, the increases in rent have been able to kind of offset that decrease, and a lot of real estate out there able to find a way to kind of save expenses here and there. But it is here to stay.
Sure. Okay, and everybody who works with ourselves looking at their portfolios on a comparative standpoint, this is the type of metrics that we get into the level of detail, is to try and interpret why those values are changing at different rates across portfolios when you get into the level of detail. But let's get back to the returns and let's get into a little bit more detail, change gears up to the returns, and now focus on the variances within the sectors across the major metropolitan markets. So to explain, folks have seen this before, this is kind of what we run our first stage attribution around when we're looking at the individual sectors. So we're ordering the 15 largest metropolitan markets. They're ordered west to east, the remainder in that aggregate bracket on the right hand side. The more the non-primary markets, the color coding shows the variances, it should be stressed, within the sectors. So whether those returns within those metropolitan markets are north or south of their respective sector averages, and those sector averages are then color coded in terms of how they perform against the overall ODCE of 5.7. The bottom table then just shows how the returns are compared with the Q2 levels, so kind of Q3 minus Q2. And predominantly, we're seeing greens across the board there, as results are pretty much all on a kind of upwards trajectory. So that 5.7% overall return is 2.2% stronger than it was back in Q2. The return for industrials of 11.6 is up nearly 4 percentage points. So hopefully that's the folks have got their heads around how to navigate around the chart. Let's just go through a few of the sectors. So let's look into the apartments first. So first of all, maybe down the bottom here for apartments, they're very much improvements across the board, and we've actually seen some sizable upticks in some of those kind of more gateway markets. Look at the movement there for New York, up 3.2. The movement there for San Francisco, up 3.4. But it's still a case of the lead performers are definitely those Sunbelt markets, and they've moved kind of even further ahead. So the biggest gains, I mean, although we're seeing gains in those gateways of New York and San Francisco, the biggest gains are, Atlanta 3.9% up, Miami 4.3% up, Phoenix 3.4% up, and Denver 5.1%, and they're very much kind of up there in the green zone in terms of leading at the front with those kind of very kind of robust rates of return. This is 1 quarter. If you look at the apartment kind of for the full year and just take that appreciation element of the return and bifurcate it then into the impacts of pricing versus cash flow to influence those appreciation levels that played out for the last 12 months, just a few points to note here. First of all, values for the year for apartments are pretty much up across the board, with the exception there down the bottom of Chicago. But there's definitely, as we're seeing on this slide, a divide opening up between at the top the Sunbelt markets and those gateways down the bottom. At the bottom end of the order, you've got San Francisco, you've got New York, and you have Chicago. So what's behind those variances for apartments? It's part pricing. So you can kind of draw a bit of a trend line there on the yield effect. I mean, you're seeing positive price adjustments across the board, but more so on those Sunbelt markets. And for those Sunbelt markets, the top end of the order, they're definitely seeing the stronger movements forward in cash flow, and it's kind of cash flow that's really been the mainstay of those value increases at the top end of the order. Contrast that with some reductions down at the lower end, and those improvements in cash flows for those kind of some of those Sunbelt markets are certainly playing out when you look at the change in market rents. The stronger upfront market rent improvements over the last 12 months, evident in those Sunbelt markets, more muted, and with some reductions at the lower end of the hierarchy, and also down at the bottom end there, you've actually got actual rents are still coming down over the year. So, Robbie, I mean, this is a year, and there's definitely variant between Sunbelt and Gateway, but this slide was maybe hinting at some of those kind of gateway markets coming back. What's your kind of thoughts on the ground when it comes to the apartment sector and the numbers we're seeing there?
Yeah, I feel like I'm playing music on replay, right? So hey, Sunbelt every quarter, right? So it is Sunbelt market, right? So it's the fundamental are super strong in the Sunbelt market, right? So the reopening as well just make people coming back to work, back to staying, to basically going to apartment, with the home price being high as well, right? So make people stay in the rental longer as well. So it's kind of combination all that stuff, right? So the gateway improving, but it's definitely not back up to where the Sunbelt market is, right? So the interesting part about apartment is basically we talk to a lot of the portfolio, the other client, what we call the loss to lease factor, right? So in a sense, trying to see where is the growth of the apartment going forward. Loss to lease are a big number nowadays, right? So like some client indicated 15 to 20% loss to lease factor, right? So which means that the contract is 15 to 20% below market. Just think about the upside of the cash flow in the near term. So there's definitely a lot of positive basically associated to apartment right now. So again, I think that you go to the next slide, Phil, right?
Sure.
So, right. And then it kind of show, right? So take the return, like what being a major driver return, right? So as we kind of use the stratum analytics, trying to kind of correlate, trying to predict some of the return, right? So similar to last quarter, the two biggest predictor of the return has been the employment growth and net migration, right? So the area with strong employment growth and long-term kind of 24 net migration have been strong. Phoenix is the top in both of them, right? So first, if you look at San Francisco, New York, Chicago is on the bottom, right? So that's kind of how we look at it, right? So it's kind of pretty consistent to what we talk about. The apartment kind of fundamental still tied to migration and it's tied to employment growth, right? So.
Sure. No, thanks very much, Robbie, and thanks to the guys from Stratum for providing that information for us as well. Let's move down to the industrials, the eye-watering industrials, and the real standouts here are the Southern California markets, LA, Inland Empire weighing in there with a whopping 22% rate of return for the quarter. But it's actually a broadly based success story. So it kind of, because these numbers are high, these numbers are in red. We look down the bottom here in terms of the changes. You get a sense of just of the widespread improvement. So it's markets that were kind of down at kind of 5-6% rates of return last quarter, and now up at around 9% this quarter. So I'm talking about kind of Boston's here, DC up at 10. What else I spot out on Atlanta, almost 10% there. Denver 9.2, Dallas 9.1, and they've seen some significant moves over the quarter, and they're kind of now catching up with New York at 9.1. So all of these ratcheting up a fair margin, and those returns would have beaten the industrial average last quarter. But it's such is the strength of those West Coast markets, especially 14%, but 22% in Inland Empire. That's what's really moved the overall average, and then kind of skewed the color coding that we see here. Again, if you break out the appreciation element, this is one quarter. This is for the full year, and you break that appreciation return into the yellow, the yield influences, and the cash flow influences. For industrials, the variant is really determining this hierarchy on the left-hand side in terms of appreciation is really on the cash flow side. You kind of draw a bit of a trend line. That's my pathetic attempt of a trend line. It's not statistically significant, but and what's really spearing the kind of the growth at the top end is the cash flow gain, and within that the record rise in rental levels, market rent. So over a year, and market rents for kind of Inland Empire up there. What's that? 30, almost 35%. That's simply staggering. Next up, you've got improvements of market rents around 15%, which is pretty impressive for LA and New York. Whereas at the bottom end of the order, when you're looking at things down there, the Chicago's, the Miami's, and the Houston, we're talking about low single-digit kind of sub 4% improvements in market rent. So there's a real kind of variant in terms of the strength of the market coming through in those market rent numbers. The growth rates were also worth a look at when you're looking at the industrial sector, and certainly play a role when we were looking at individual portfolio comparative performances. Here, 20 basis points improvements in growth rates on a 10-year average over a 1 year, but included in that, up top, those growth rates for LA, Inland Empire, they're up almost kind of 50 basis points on a 10-year average. So included in that, I looked at the 1-year numbers. So the 1-year numbers in the last year for industrials in those top markets have gone from 3 to 5% in the last year, whereas the 1-year rates are still down around 3%, down at the lower end of the order. So yeah, Robbie, what's your narrative for those Southern California markets, but in particular in the Empire?
It is a supply issue, right? So I mean, if you look at the Inland Empire, as we talked last year, and last quarter, we talked about the vacancy factor being 2.5. It's now sub 1%, right? So depending on which market report you see, it's like 0.7 to 1%. It's pretty much full, right? So you take on the LA's 1% or sub 1%, depending on what report you look at as well, right? So Orange County is the same exact thing, 2%. The market are super tight. There's no vacancy left in basically the rivers and LA. And not only there's not enough space, there's not like the availability of developer land also very limited in that market, right? So, and then you heard the supply chain, you heard the amount of kind of cargo ship coming in there. There's just not enough space, right? So at the end, market rent you sign today, 2 weeks later, is under market, right? So it just basically like that's like market rent continue to go up, right? So, and that's pretty consistent to what the earning report by the REITs, right? The industrial REIT reporting the same exact thing, the coastal market, right? So the market rent coastal market, they're up significantly as well. Like the one in Southern California, some of them indicating the rents up like 20 to 25% number, right? So very similar to what we see in here. It just on the rent perspective, on Southern California market are super strong.
Yeah, sure. Thanks, Robbie. Okay, let's go to, actually, do you want to maybe just talk to this one as well, yeah. Robbie? This is quite useful.
Yeah, so basically taking all the industrial in the ODCE that we handle, right? So putting into a machine learning strategy, trying to see what other factor that will predict it, an outperformance of specific industrial compared to the average. So some of the part might be kind of like a typical, you would kind of consider. Some of the stuff might be not something we think about, right? So actually the one that the heat map on medium home value, right? So basically if the area medium home value by the area of the warehouse actually have a positive effect, right? So you look at it, LA and Inland Empire. And the other thing as well, we all know the distance from major shipping hub, right? So population was a big one, right? So you look at the LA populations being strong, therefore they're positive, same as New York, right? So and the one that we didn't think about is percent population without health insurance. If you look at Houston, they actually have a lot more in the surrounding area. They have no health insurance. They actually have a negative impact, right? So the same as population growth, same as also percent employment in transportation warehouse. So what that means is basically now we can take it another step further, right? So not only using the normal kind of like a cash flow and yield, also trying to see what other factor would have driving the return of industrial compared to the average industrial.
Yeah. Yeah, that's good. And this is Stratton, the folks there taking every asset that we have, working these metrics on it. So definitely be able to run this through on a comparative basis as well. So on to the offices, just a little bit conscious of time, but I think we'll do fine. Offices up there again, Boston. So there's an element obviously of kind of life science MAB that's feeding into that as well. Seattle is also very strong for this quarter, up at 3.9%. Noted that there was some significant sales boosting the performance numbers, there. Other is also outside the primary markets. We can dip into that in a couple of slides' time. And Miami was the kind of maybe the surprise package, the one that kind of moved ahead. That of those kind of office markets have been a little bit more sluggish previously, so that's kind of stepping up. So maybe an indication of things to come. If you look at the variant on the office markets, on the appreciation on a 1-year basis, because this is 1 quarter, the first thing is that most of the values are still south. I mean, what's up over the years, Boston and Seattle, those non-primary markets into that other grouping. If you look at the relationship between the top and the bottom end of the order, it's partly dictated by pricing, it's partly dictated by cash flow. So on the pricing side, on the yield, you've got positive pricing adjustments in those top end markets, but yields are moving out. On the bottom end of the order. So earlier on, when things looked a bit kind of static, there is that spread, and also that spread on cash flow, kind of improvements in cash flow positions versus contractions over the last year. And some of that gets played out when you're looking at a metric like market rent. I thought other one that's maybe useful to throw in here is those occupancy numbers, because irrespective of what market, occupancy levels have come down a little bit more so at the lower end of the order. But maybe, Robbie, just maybe going back to this one in terms of Seattle, there were transactions and that's definitely boosted that number. Maybe a little bit of a comment there on Miami in terms of that kind of being quite a big mover this quarter.
Yeah, I think on Seattle front, when people kind of look at, hey, is any transaction yet? That's actually the first spot that kind of transactions start occurring. We know that the well lease office is transaction, but now Seattle, there's actually multiple bid on what I call the traditional office with multi-tenant, with some role, and there's a lot of bid out there as well, right? So and the bids coming in and better than expected as well. So I think there's sign basically office the transaction that start coming back, right? Again, it's one market right now, but they're definitely kind of some market, not only one market. I think we see that in Seattle, in New York, we see that in LA. So they're definitely more and more transactions are coming back on the office front. And Miami is basically the overall leasing improvement, right? So we know the Sun Belt has some seeing leasing improvement. So that's what we start seeing the first showing of it in Miami. So.
Okay, thanks. Okay, so changing tack a little bit again, just going beyond those kind of broader geographic themes, focusing on some of the more immediate localities and subtypes. So this is for the quarter. The blue bars are the actual returns, not to be confused with the numbers down the bottom here, which are the percentage weights that these groups consist of the overall Odyssey data set. So just maybe start with the apartments on the left-hand side. I think the noteworthy point here is that everything's either matching up or north of that dotted line, which is the overall Odyssey average. So whereas high rises more urban have been lagging behind that, they've now caught up. So that's maybe just an indication of the improvements that we're seeing across the board within the multifamily sector, but it's clearly still the kind of the garden, more suburban type products that are kind of leading from the front there. Offices, the reverse, everything is still south of the overall Odyssey number. We've thrown in MOB, medical office buildings there, just to show that very different facet from the wider office sector. But if you're looking at the four-way breakdown that NCREIF now provides into the office market, then it's still very much the downtown, the CBD markets that are still seeing the more subdued and the lower performance numbers. Outside of that, returns are all north of 2%, so there's some appreciation built into those returns in urban, suburban business district and suburban. And then across the retails, you've got the regionals, super regionals still trailing behind the neighborhood, the communities and the power centers. In other, that just goes to show that it's the self-storage piece that's really leading in that part. Conscious of time, but maybe just a quick word in terms of the retail side of things, Robbie. Looking at these numbers, I mean, the malls of values have held up. Now the non-malls, sorry, for the last couple of quarters now going positive. Still not seeing a huge amount of movement up on the malls at this stage, but certainly better than where things were. So definitely easing off. So any just thoughts you wanted to throw into the retails at this stage?
Yeah, that negative on regional mall, right? So it's more recharacterization of kind of redevelopment. So basically redevelopment one assets being moved from the mall side to basically the other property type, right? So it's not a true negative. So relatively the mall stable, the non-mall are where start seeing kind of transactions. So you start seeing a positive sign there. And I think that even the mall side, there's two lifestyle center, the Class A that's recently transacted. It's kind of showing some sign as well on some of the bigger assets. So yeah, there's definitely positive story there. Not fully back, but that's definitely green shoot here and there.
Good, thanks. Okay, so the last thing we wanted to look at is that kind of non-primary bracket, so the other sector. So you look at it for the year, overall obviously return for the year is 12.9. If you go into the other grouping outside the 15 largest CBSAs, you're getting a return of 15.4. So there's clearly something noteworthy to be said within that kind of group of markets, which are a kind of a variable mix, and we've listed them all out here where there are some benchmark numbers that come through from NCREIF. We'll peel back the layers because there's a lot of detail here. I think the first point to note is if you look at the sector weightings across kind of everything versus the sector weightings within the other kind of metropolitan markets, and that slice that's accommodated by the industrials. So a little bit less than 25% for all Odyssey, over kind of 25% when you're looking at into the other grouping. So these other regions do have more of a tilt towards the industrial sector. So there's going to be a sector kind of bias here pushing that number because they're getting more of that kind of high 30s return that the industrials are delivering. But then if you look across within the sectors, the overall return that's shown by apartments, offices, retails, other industrials versus the returns that are being achieved in these kind of non-primary markets in green, pretty much all of them are ahead. The exception is industrials, and that's almost the fact that those Southern California markets are so strong. But just peel back the layers and just to see what's in there. So for the apartments, just strip those down to the red dots and kind of just dulled out the ones that there's no representation. That's the average for overall apartments. So others definitely running north of that. Put 15.4% as a collective. And in here you're picking up one of those sunbelts, the Orlandos, the Raleighs, the Charlottes, Tampas, Nashvilles. They're all sitting north of that 12.8% return line. If you look at things for the industrials, so obviously the numbers rise, and a lot of them are up north of that 30% level. We've talked about the numbers in prior quarters. We talked about that overspill from New York down the I-95 corridor, kind of part of the growth being there. Like to Baltimore, Philadelphia, but yeah, overall, the wider industrial market certainly being driven a little bit even further forward by likes of Inland Empire, which is kind of even eclipsing some of this. And then on to the office markets, the ones that aren't covered in the larger 15, and you can see with those blue dots above this line that are coming in north of the overall office average for the year 4.4, bringing it up to 6.4. The standouts there from a return standpoint would be Charlotte, would be San Jose, would be Austin. They're the ones that are coming up north of that, bringing it up to 6.4% overall, and less so the likes of Portland, which are more subdued lower down the order. But hopefully just thought that'd be useful just to kind of get that level of insight into the other markets that are moving the needle, because when you do look into this kind of other grouping, there is definitely some stronger return numbers. Appreciate we've most probably done quite a lot of the time allocation, Rick, here. So the last slide is just some wrap up points, but I don't know if there's any questions really that have come through the chat line that you wanted to pick up on with Robbie and myself at this stage before we wrap up for the hour.
Yeah, no, exactly. Yeah, quite a few questions come through, so we'll try and answer them quickly. And maybe I can even answer some of them. So one, SFR, there's a question of whether that's in other, if there is anything in there. I know several of the clients some of the funds are looking at doing SFR. I don't know if there's actually any in the other component.
They will be. I think NCREIF's kind of reclassification is to put them into the other. I believe they're starting that from Q4 of this year. We'll give a narrative back on each of these questions, and actually going to be at NCREIF next week, so we can definitely get clarity for that. That's where they're asking it to be categorized. I don't think we've seen any single family rental coming into these portfolios at this stage, so I don't think it's impacting these numbers, but I think the directive is for them to fall there.
Okay, so and actually Michael Carey, who's with our group who oversees the SFR evaluations, he's actually going to be speaking on a panel there, so that might be something that he can address there as well. Yeah. The other thing is, so question on the other sector, how much of the index is in the other sector? I think it's 4.7% you had on that one slide.
Yeah.
And then the breakdown they're saying is or what is the breakdown? I think most of it's self-storage and student housing.
65 is self-storage. So 65 is self-storage, and then Senior living and healthcare, the collective is about 20%.
Okay.
The larger component is definitely self-storage.
Okay, good. Slide 16, if you want to flip there. Good question on multifamily. You know, it's just talking about how well the Sunbelt markets are doing, but Houston seems to be lagging on the cash flow effect. Any comments there as to what's happening there? Is it a supply issue, which seems to be a Texas theme?
It is, yeah, it is some supply issue as well, right? So in Houston have a lot of there's a lot of supply there, right? So for the other market that's seeing there's not a lot of supply, so occupancy in some of the market are super strong. So it's moving up, but it's not as high as the other market yet. So
okay. So the industrial, so you mentioned it's always sunny in industrial or always sunny in Southern California. And also, I think every quarter I talk about the number of ships. I think we're up to 73, although even last month, I think it was over 100. And an interesting tidbit I just saw the other day, those 73 ships, if you line up all those containers end to end, it would go from LA to Chicago. So it'd reach from me to you, Robbie. So a lot of ships being, you know, and gets back to the under 1% returns. Is Inland Empire, LA outperformed? How much of that? I think it was over 22% in Inland Empire for industrial. How much did that contribute to the overall return for ODCE?
Go ahead. No, you go, Robbie.
Yeah, do I look at on the cash flow front? If you look at the movement on industrial, a lot of them are from cash flow side, right? So that's what contributed to it because it's not enough supply. So every rent out there is higher and higher. And that's if you look at one of the slide is an industrial on the other market. The other one that's going strongly, Las Vegas, right? So it's basically now Southern California is full. You go to Las Vegas. Las Vegas is 2.3% vacancy now, right? So that's kind of what's going on. I think that specifically to that, like kind of in the sense supply chain is hard to put in together, but it's all that demand coming in there. The bottleneck is definitely in that port. It's also the other bottleneck is basically the lack of supply, right? So and then you get the filter effect. We've seen that in New York, right? So the New York is kind of going all the way down to Baltimore, and the same is kind of going on the West Coast as well.
I mean, in terms of just, I think also the point of just quantifying the actual return, and we do this for across all those segments. So I do kind of just digging that out. I mean, that alone has added 50 basis points to the overall return. So if you took those Inland Empire assets, industrial assets out, the return for the quarter of 5.5 goes down to 5.2. So and they account for about, just looking at my notes, about 3% of the overall ODCE in weight. With a 22% return, they basically add 50 basis points to the overall performance number of 5.7. So
almost 10% of the return. And so a comment just came in on, you know, isn't at best as the last couple of quarters so Robbie the weatherman, is it too sunny? Are we going to have global warming? Is industrial getting too high now? You know, could this create this attraction of investors for industrial assets? Could it create some kind of bubble, or are we in some kind of bubble?
It's kind of hard, right? The way I look at it is 80 degrees too hot for some people? Maybe it's not, right? So it's a tough one. The issue is basically we know there's demand there. We know there's still a lot of ship out there that need to be put into the warehouse space, but where's the supply, right? So if you look at Inland Empire, it's like less than 1%. Where else do you put them? And it's total construction. If you look at the total construction on the market right now, it's like 3% of the total market. In LA, it's less than 1%. I think Orange County also the same as less than 1% of new construction. And a lot of new construction is already leased up as well, right? So the issue is like the supply are not fast enough to catch up. So the rent will continue to go up. Not sure how high it is because the way I look at it right now, that the rent as percentage of the business cost for a lot of this kind of retailer or the people kind of 3PL is not that big percentage, right? So how high it is, no one really know yet. So we're definitely going to continue to monitor. Is it too high? I don't think anybody know the answer to it. It's always a question that investor, everybody bring it up. What is the top, right? So like, do I look at it, is 80 degrees too hot? For some people it is. For some people, it's not. Right?
It's all relative.
Exactly. So,
and a good thing is that rents are doing, you know, they're getting the market rents, and that the thing would be is you're looking to, you know, year 2 and 3 and higher market rent growth on top of the higher market rent, something to consider. Lot more questions are coming in, which are good. I think we're pretty much out of, yeah, we're over time now. So what we'll try and do is respond to these questions and circulate these. And again, Phil will be doing the roadshow, somewhat physical this quarter as well as virtual. And they'll make sure and answer some of these questions in general for all the clients as well. So thank everyone for coming. Any quick final thoughts, Robbie or Phil?
No, just to your point there, we obviously look forward to talking to these results with everyone on a one-to-one basis over the coming weeks. So yeah, thanks everyone for their interest. All the feedback we get on this as well is great, because it starts to drive how we start to look at these numbers as well. So no, appreciate everyone's support around this, and obviously to everybody within ODCE as well that works the valuation data and the performance team that brings this together. So a big thank you, everybody, and look forward to catching up with everybody on a one-to-one basis. So no, thanks very much.
I agree.
Thanks, guys. Thanks, everyone.
Thanks everybody for their time today.